Other times it can trigger, easily a 10% correction or more, as some steam is let out of the market and some of the valuations reset themselves. So it's hard you have to be a trader to really kind of, capitalize on those movements. But I do think that from a long-term investor standpoint, this is certainly an environment where you want to be very, very careful with the amount of money, the valuations you pay for companies you like. When you look at the size of the gold market, I mean, estimates from the World Gold Council, if you look at how much above ground gold they think there is, and you multiply it by the price, you get something around $12 trillion. Obviously, that fluctuates based on what the prevailing price of gold is, but that's roughly the order of magnitude. But then when you factor out, say, central bank demand or certain types of jewelry, if you look at, say, coins, bars, ETFs, things like that, you're looking at maybe $5 trillion asset. So one, we do see that equity valuations are pretty high across the board, but not evenly though. We still see value stocks out there with very reasonable valuations, but we also see, especially in the tech sector, very, very high valuations that require high expectations in order to justify themselves. At the same time, we see, households have record high equity allocations. And some of that simply because, the equity is appreciated in price, but it's also because they look at their cash and bonds that are yielding below the inflation rate, and they say, well, I got to own some equities. And so, they're kind of piled pretty heavy into that equity side of the portfolio. We've also, of course, we had the meme stock phenomenon, the trading phenomenon. That's, to some extent, that's also spilled over into crypto, obviously. And so there has been a lot of kind of risk-taking behavior, as you've seen, the Federal Reserve be as dovish as they have been, and as you see interest rates super low, you have all these issues. So now that the Federal Reserve is talking about the possibility of tapering, now that valuations are this high, I think that there are a number of investors out there that are concerned about risk. And so I would say a lot of economic indicators look like they're decelerating, meaning that most of them are still growing, but at a slower pace than they were in a year-over-year basis. Some of them are outright contracting, like retail spending. Fiscal stimulus is kind of in the rear-view mirror now, right? So, there were these multiple rounds of stimulus checks and extra unemployment benefits, and those are behind us, or in some cases still rolling off. And so there's kind of fewer reasons to be optimistic. Now we still could get another leg up, for example, but it's basically the market has already squeezed a lot of juice out of this run. As you point out, I mean, we made tons of new highs this year. If I remember correctly, I think we've gone like 10 months without a 5% pullback, which is a very long stretch of time. And so, there is, I think, some buyer exhaustion out there. And so when you do see that margin go down, historically, that sometimes it's been the beginning of a very major decline, like in 2000 or 2007. So obviously in recent months, we've had the Delta variant kind of on the headlines for a while. It's been hitting Southeast Asia for a while in particular. So it's been slowing down that growth engine. It's also been hitting China, and China's in the middle of a contracting credit cycle as well, which, a lot of charts show that, with a multi-month lag after China goes through kind of a credit contraction, usually you have global PMIs and other kind of measures of acceleration kind of roll over as well. Other times it can trigger easily a 10% correction or more, as some steam is let out of the market and some of the valuations reset themselves. So it's hard you have to be a trader to really kind of capitalize on those movements. But I do think that from a long-term investor standpoint, this is certainly an environment where you want to be very, very careful with the amount of money, the valuations you pay for companies you like. So I still think there'll be a successful company, but I think that there's certainly, I think, better areas out there to deploy capital than sticking it in Apple. They're also, of course, they're vulnerable to supply chain disruptions, maybe more separation between China and the United States. And even some of the other FANGs, in my opinion, are potentially better risk-reward opportunities than Apple itself, let alone companies that are maybe mid-caps and that have, say, either faster growing potential. So Apple has outperformed my expectations fundamentally and in terms of price. But going forward, I don't view it as the best risk-reward ratio out there. One hand shows that, we pretty much have hit peak cell phone, meaning that, the number of new smartphones sold per year has probably peaked. It's kind of reached saturation as a technology. Of course, there'll still be people in emerging markets that are still getting it, right? I mean, I think the saturation is something like 4 billion people worldwide with a smartphone at this point, so there's still room to go. But overall, we pretty much reached market saturation. And so for Apple, the biggest question is whether or not they can continue monetizing their ecosystem of services, right? So that's kind of what separates, say, when you look back at history, usually consumer electronics companies don't have super long lifetimes at the top, because there's always a new competitor that comes along and does things a little bit better. But what we've seen from these tech titans like Apple is they build a whole ecosystem, which gives them a wider economic moat in the Buffett sense, right? So obviously Buffett also is a big bull on Apple historically. And so that's somewhat different than just how many phones they sell. It's how much they can get out of ongoing usage of that phone and that overall ecosystem. So I think if you were to have a bear market in equities, I do think that gold would probably outperform equities. Whether or not gold would do very, very well in absolute terms, I think is an open question. The longer term issue is that, I do think that the crypto market has become large enough to take some demand from gold. So when you look at adoption, statistics, for example, it's getting to the point in the United States where about as many people report owning some Bitcoin as gold, and especially that skews younger, obviously, whereas gold investors tend to skew somewhat older. But I do think that if you were to get a pretty significant risk-off bear market period, especially if you have one that's driven somewhat stagflationary. So gold historically follows real interest rates pretty closely. In recent months, that correlation has been a little bit weaker than normal, but over like a 50-year period, it's been a pretty strong correlation with inverse correlation with real rates. And so when inflation's higher than the 10-year Treasury yield, gold tends to do reasonably well. And so if you were to get, say, decelerating growth, economic growth, at the same time as you have inflation still being sticky and high, which compresses business margins and causes kind of issues throughout the economy, that should be a pretty good environment for gold. And especially at a time where sentiment's pretty low right now, a lot of people are asking the question, as gold kind of lost its luster. Ironically, that tends to be the time where, probably gold's going to do reasonably well. So I wouldn't count gold out yet, even though I do think that cryptos are eating into its market share. When you look at the size of the gold market, estimates from the World Gold Council, if you look at how much above ground gold they think there is, and you multiply it by the price, you get something around $12 trillion. Obviously, that fluctuates based on what the prevailing price of gold is, but that's roughly the order of magnitude. But then when you factor out, say, central bank demand or certain types of jewelry, if you look at, say, coins, bars, ETFs, things like that, you're looking at maybe $5 trillion asset. And so the fact that the crypto market has reached about 2 trillion is pretty interesting. It's basically it's getting in the ballpark, at least, where it's taking, I think, some meaningful demand away from gold, or at least taking the edge off. And I personally know a lot of people that say that they, if it wasn't for, say, Bitcoin, they would have bought gold instead over the past several years. And so I think around the margin, it's kind of, you can describe it as splintering demand, where kind of you had gold, Bitcoin came along and kind of maybe took some of the demand that might have otherwise gone to gold. Then you have other cryptos come around, and especially during bull markets in the crypto space, they tend to take some market share from Bitcoin even. And so money just kind of diffuses. It's like a going through a prism. It just kind of diffuses into multiple different things. And that can kind of take the edge off, especially some of those larger ones.